Ever trying to figure out what a company is really worth? Like, how do you actually put a price tag on something so complex? Today, we're going to try to figure that out. We're diving into the Little Book of Valuation by Aswath Damodaran. It's a fascinating look at how we value companies, or at least try to.
And it really is fascinating because even with all the fancy models and equations, it often feels like we're trying to predict the future.
Right.
Right? And Damodaran actually emphasizes that. He says it's less about finding that perfect number and more about understanding what truly drives a company's value. What are those underlying factors?
It's about the why, not just the what. So the book talks about two main approaches to valuation. The first is called intrinsic valuation.
Right, and that's all about understanding the fundamentals of the business. What are their expected cash flows? What risks are they facing? It's about figuring out what the company is really worth based on its own merits.
Like looking under the hood.
Exactly.
Then you have relative valuation.
Which is more about comparisons. We look at how the market is pricing similar companies. Like if you were buying a house, you'd look at what comparable houses in the neighborhood sold for.
Right, you get a sense of the market.
Exactly. So you're using those benchmarks to see if a company is potentially overvalued or undervalued.
Makes sense. Now, one thing that really struck me in the book was this idea that when it comes to valuation, time is money. Which, okay, we hear that all the time, but what does it actually mean in this context?
It's all about this concept called the time value of money.
Okay.
$1 today is worth more than $1 you might receive, say, 5 years from now.
Because you could invest that dollar today.
That's exactly it. You could invest it today and earn a return. So when we're valuing a company, we can't just look at their future earnings in a vacuum.
Right, because those future earnings are...
They're worth less in today's terms.
Got it.
We have to account for inflation, risk, all of that.
So how do we actually adjust for that?
That's where discounting comes in. We use a discount rate to bring those future earnings back to their present value. It's like applying a time machine to money.
A time machine for money. Love that. And the discount rate, that's based on?
A bunch of factors. The riskier the company, the higher the discount rate. Higher risk means a lower present value for those future earnings.
So a company with really unpredictable earnings would have a higher discount rate compared to, say, a well-established, stable company.
Exactly. You're basically saying, look, I need a bigger discount to compensate me for the uncertainty.
Makes sense. Now, the book delves into all these different types of cash flows, like annuities and perpetuities. Are those as complicated as they sound?
They can be, but the core concept is really straightforward. Annuities are basically just a series of equal payments over time, and perpetuities are like annuities that go on forever. The key is understanding that time has a very real impact on the value of those cash flows.
Time is money.
Got it. So we've talked about these fundamental valuation concepts, but things get even trickier when you start thinking about companies in different phases of their life cycle, right? I mean, a brand new startup is valued very differently from, say, a well-established company.
Oh, absolutely. It's like it's like using different tools for different jobs, right?
Mm-hmm.
And Damodaran really drives that point home. He talks about how your valuation approach needs to adapt based on where a company is in its journey.
Right. So like the book uses Evergreen Solar as an example, and they were losing money at the time. So how do you even begin to put a value on a company that's not even profitable yet?
That's where it gets really interesting. You have to kind of gaze into your crystal ball a little bit. You have to make some projections about the future.
Even if the present is a little murky.
Exactly.
Yeah.
With a company like Evergreen Solar, you'd look at their revenue growth potential, like how fast could they realistically scale? And what are their target operating margins? What could those look like down the line? So you're kind of saying, okay, they're in the red now, but if they can hit these ambitious targets,
Yeah.
then what would their future cash flows look like?
Precisely. And you can look at comparable companies as benchmarks. Like if other solar companies have achieved certain margins after a certain level of growth, that gives you a starting point for your projections.
Makes sense. But still, young companies are inherently risky.
Right.
So how do you factor that into the valuation?
That's where those discount rates come back into play. You adjust them upwards to reflect that higher level of uncertainty. Remember, high growth doesn't automatically equal a high valuation. The book stresses that sustainable margins are key. It's not just about growing fast, but about growing profitably, right?
Right, because you could be growing really fast, but if you're not making any money,
It's not sustainable.
not going to last.
Yeah.
Okay, so we've talked about young companies. What about more mature businesses?
Well, with mature companies, things tend to be a bit more, stable. They have established market positions, more predictable earnings. They're not as wild and unpredictable.
Right. But even the big guys can stumble, right?
Yeah.
What happens when you need to value a company that's in decline? Maybe they've seen better days. How do you approach that?
That's when the detective work really starts. You need to understand why the company is declining. Is it their revenues? Are they stagnant? Are margins shrinking? Maybe they're selling off assets. You have to look for clues.
Like, is this a temporary blip or a sign of bigger problems?
Exactly. And here's where it gets really interesting. The book talks about factoring in the probability of distress, financial distress.
Oh, wow.
Yeah, and you can actually use something like bond ratings to gauge how risky a company is.
Wait, bond ratings? How does that even play into a company's value?
It's actually really clever. Bond ratings, they reflect the creditworthiness of a company, how likely they are to repay their debts. So a low bond rating suggests a higher risk of default, which definitely impacts the company's overall value.
It's like looking at their financial health from a different angle. You get a more complete picture.
Absolutely. And that's what makes valuation so multifaceted, right? You've got to consider all these different angles to make an informed judgment about the future.
It's not as simple as just looking at the balance sheet, that's for sure.
Mhm.
So far, we've mainly focused on the hard numbers, cash flows, margins, all that. But the book also talks about something called intangible assets. And those seem a lot more difficult to get your arms around.
They really do. This is where we move beyond the traditional financial statements and start thinking about things like brand names, their reputation, technological expertise, customer relationships. These are all valuable, but they're not always so easy to quantify.
Right, like how do you put a dollar value on brand loyalty, for example?
It's tricky.
So we've covered a lot of ground on valuation, but I'm realizing that different industries probably come with their own quirks. In the book, Damodaran talks about some of those industry-specific challenges, and there are two that I'm particularly curious about. The first is financial services.
Yeah.
Banks, insurance companies. Those always seem a bit mysterious to me.
They do have their own unique intricacies, let's say.
Intricacies, yes.
Mhm.
So what makes valuing financial services companies so different?
Well, for starters, their balance sheets are fundamentally different from, say, your typical manufacturing company.
How so?
They hold a ton of financial assets, loans, investments, mortgages, and those can be really, really tricky to value accurately.
It's like their assets are just
Yeah.
other financial instruments.
Exactly.
It's a bit of a mind bend. So how do you even begin to figure out what, say, a bank is really worth?
You've got to roll up your sleeves and dig into the details of those assets. What types of loans are they making? What kind of interest rates are they charging? How risky are those loans? What's the probability that they won't be repaid?
That sounds complicated.
It can be. And then on the flip side, you have to look at their liabilities and customer deposits, any debt they've taken on, and understand how those are structured.
Right, because those impact the risk too. Now, the book also mentions that some of the traditional valuation metrics, like the price-to-earnings ratio, they might not be as reliable for financial firms.
You're right, and that's because, remember how we were talking about earnings being, being impacted by all sorts of factors, even accounting decisions? Well, for banks and insurance companies, earnings can be really volatile.
Right, they can swing up and down.
Exactly, and they're often subject to these adjustments that make it hard to compare them directly using something like a PE ratio.
Okay, so if we can't rely on PE ratios as much, what should investors focus on when they're trying to understand the value of a financial institution?
Well, Damodaran suggests looking at metrics that give you a clearer picture of their financial health. Like, one is the price-to-book ratio,
Okay.
which compares a bank's market value to its book value, which is essentially the value of its assets minus its liabilities.
So a low price-to-book ratio, that could potentially mean that the market is undervaluing that bank.
It could be a sign. It's definitely worth, digging a little deeper. Another important metric is dividend yield. Banks and insurance companies tend to pay dividends, and a healthy dividend yield can be a good indicator of a strong financial position, a management team that's feeling confident about future earnings.
It's interesting. It's like you're looking for these industry-specific clues to help you piece together a puzzle.
Exactly. And don't forget about the regulatory environment. I mean, banks are subject to a lot of scrutiny, a lot of regulations, and that can have a big impact on their profitability and the risks they can take.
Right, another layer of complexity. Okay, so we've talked about financial services, but the other industry I wanted to touch on is cyclical industries.
Ah, yes, the companies that ride the economic roller coaster.
Exactly. Airlines, automobile manufacturers, companies that are really sensitive to those economic booms and busts. How do you even begin to value a company when their earnings are on such a wild ride?
Well, it's all about understanding the cycles, right? What's fascinating about cyclical companies is how much their valuations can swing depending on where we are in the economic cycle.
Right, like during a recession, their earnings could plummet, but during a boom.
They could be through the roof.
So how do you determine what a fair value is when it's constantly changing?
Well, that's where we use this concept called normalized earnings. The book really stresses looking beyond the short-term fluctuations and trying to figure out what a company's earnings would look like in a more typical or normal economic environment.
So you're kind of trying to smooth out the peaks and valleys, right?
Yeah.
To get a better sense of their, what did you call it? Their underlying earning power.
Exactly. And that can be tricky, but there are ways to approach it.
Like what? How do you actually go about determining those normalized earnings?
Well, one common approach is to look at a company's historical earnings over a full economic cycle, so you're capturing both the good times and the bad times. And then you would adjust for any one-time events or accounting changes that might have skewed the numbers.
So for example, like we had this massive pandemic a few years ago,
Right.
which was obviously a major anomaly. So you'd want to adjust the earnings for that period to reflect what would have likely happened under more normal circumstances.
Precisely. You're trying to create this more realistic picture of their long-term earning potential. And that's super important for cyclical companies because you don't want to overpay during a boom when their earnings are artificially high, but you also don't want to undervalue them during a bust when everything looks bleak.
Wow, this has been such an eye-opening conversation. We've gone from the fundamentals of valuation all the way to these industry-specific nuances. I have to say, the little book of valuation really does live up to its name. It takes a complex topic and makes it approachable.
It's been great unpacking all this with you. What I really appreciate about the book is how it emphasizes that valuation is not just about plugging numbers into a formula.
Right. It's not just about the math.
It's about understanding the story behind those numbers, asking the right questions, connecting the dots.
And being willing to dig a little deeper, challenge your assumptions.
Absolutely.
Well, this has been a fantastic deep dive. Thank you so much for guiding us through it.
My pleasure.
And for our listeners, if this has piqued your interest, we highly recommend checking out the Little Book of Valuation yourself. It's a great resource for anyone who wants to level up their investing knowledge.
And remember, valuation is a journey. The more you practice, the more you learn, the more confident you'll become.
Absolutely. And on that note, we'll wrap things up for today. Until next time, keep exploring, keep learning, and keep diving deep.
It's your body.